Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for December 20th of 2021. Please see our disclaimer for important information. We start out this week with our high frequency data, courtesy of First Trust in Chicago. You can see the level of change relative to 2019, kind of the pre-pandemic view here. A little bit of change, TSA checkpoint data. We're in a high travel season. Obviously, the holidays, commercial flights down around 18%. It's kind of been holding in that 15 to 20% range. Hoping we can see some additional traction there at the beginning of next year because we clearly see more mobility on the part of people. Obviously, gasoline sales relative to 2019 are up. And then other categories, hotel occupancy, really gaining a lot of ground. We see that difference versus the pre-pandemic era really narrowing. We're down now around 5%, open tables around 13%. That's been pretty steady. But when you look at other things, staffing and jobless claims, I mean, the labor market continues to improve. In fact, we're back to record level lows of initial claims for jobless benefits. Now, we'll look at manufacturing for a brief second, and the backlog of work is trending down, which is interesting. So, what this tells us a little bit is that some of these supply chain choke points are beginning to ease just a little bit. Again, they're still at relatively high levels, so the problem clearly has not gone away, but it's not nearly as acute as it has been. On the right-hand side, I've got manufacturing PMI, Purchasing Managers Index. Now, these are input prices. So again, to the notion that we've had a lot of producer-based inflation has been absolutely true, and you can see this in this chart where this index has really spiked, but it's coming off those highs. So not only are we seeing a little bit of break in this adverse trend that we've been seeing in terms of backlogs, but also in prices. Now, as we'll see in just a second, the service sector is really going the opposite way, but at least manufacturing input prices are beginning to ease just a little bit. Now, switching to inventories as kind of a measure of where future investment is going to go. We just talked about perhaps an easing in some of the supply chain issues, input prices and whatnot. Now, we do know that private inventories are way down. You can see that clearly here, and this is something that is kind of was beginning to roll over a little bit even before we had the pandemic. And it's just accelerated since. So, anybody who's been out Christmas shopping or gone online and found that some of the things that they wanted to buy were out, this is really a chart that kind of speaks to that. And so inventories are relatively low. And usually when you have a situation like that, you have a production response to try to catch up and restock those inventories. And I think that is apt to happen. Companies are flush with strong balance sheets and have the ability and actually the willingness and the desire to want to spend money on capital infrastructure to help to address some of these inventory choke points. And I actually think that inventory rebuild looking into 2022 is going to be a tailwind for the overall economy. And you can see here, we're at levels that we haven't seen in several years, and I think it puts us in really decent shape as some of these supply chain choke points and as some of this new investment in productive capacity comes online to help reverse these trends. And here is that quick look at capacity utilization, and you can see that this trend line that goes back to about 2005, so about 15, 16 years here. You can see that we're back into trend line, at least in terms of the percentage of productive capacity that is being utilized. But it really does set the stage for continued investment. And a lot of the gain that we have realized over the last year is just simply capacity that's coming back online after having literally been shut down at the drop of a dime. And we are back to pre-pandemic levels to some degree, but with those inventories in the last slide being relatively low, one would expect to continue to see utilization move higher, which in turn is going to inspire companies to want to spend more on productive capacity. Well, speaking of manufacturing, here's a quick look at motor vehicle production, and obviously much has been made over these many months about the issues related to vehicle production, the lack of semiconductors to actually be able to finish a lot of the vehicles, and having a lot of interim product that are in interim phases of production kind of sitting idle in yards right now because of the lack of certain components. But the good news is, in the wake of some of these massive price increases, in fact, some relatively new used cars are worth much more than you could find them new on the lot now. So, but the good news is that dislocation may be on its way, eventually to easing here over the coming months. You can see the motor vehicle production growth positive month over month here over the last couple of readings, and I think that bodes well heading into next year for some price relief. Now this is one of those things that when the average age of the vehicles that are actually on the road today have continued to move higher over the last 5 to 7 years, and so there's a lot of older cars that at some point are going to need to be replaced. And so having additional production coming along, having relief on prices is going to be a fairly significant thing for the consumer over the next year to 18 months. Well, before we talked about the manufacturing side of the coin when it came to input prices, and now we're going to talk about the services side. And so as you can see here, input prices for services are moving the opposite way from manufacturing, and a big part of this is labor. The supply of labor, we've talked, we do have some charts on the labor market coming up, but labor is tight, and there's a certain kind of uniqueness to the labor market right now that we haven't really seen because of this pandemic and the kind of some of the latent issues related to childcare and whatnot, and the desire to do different things in different industries, and labor mobility is just kind of at a very unique point right now. And so, notwithstanding all that, the supply of labor and the labor market tightness is causing labor costs to go higher, and that's becoming a real input issue for services firms, people in the service industry. And I think that's going to persist for some time. Now, with regard to labor, I offer this chart from JP Morgan Asset Management, which I thought was really interesting. So it plots unemployment rate against wage growth. Over the last 50 years, the unemployment rate has averaged about 6.3, while wage growth has averaged about 4. And you can see that those straight lines across the chart here represent those long-term averages. And you can see how they've oscillated over time. And also the fact that there's a fairly strong relationship here at hand. You can see that when the unemployment rate goes down, you inherently have a rise in wage growth. I mean, that's pretty intuitive. When the supply of labor goes down, the cost of that labor goes up. And we are clearly seeing that right now. And this is kind of the manifestation of a multi-year trend. I mean, we've been stuck in albeit a low wage growth environment that was just anywhere between 2 and 3%. Lately, obviously, we've had a breakout, and the spike in unemployment was obviously due to the shutdowns in the economy, which prompted a rather visceral kind of change in wage growth. But as we begin to kind of normalize, I think what we're seeing here is a picture unfolding that I think we all know is there, but it just the plot here between unemployment and wage growth, I think, is unique in the sense that unemployment rate continues to drop, a tight labor market, and we've got pressure on wages. And if you go back in this time series, you'll note here that we haven't had wage growth like this since the early 80s. And that was really following kind of this period of exceptionally high inflation from the 1970s, where we witnessed, in many respects, a stagflation, but high inflation in the early 80s that the Fed stepped in and raised interest rates quite a bit to try to combat. Not saying that we're going there, but it's just that we have not seen wage growth like this in a long time. And I do think it's going to be a little bit sticky as we kind of read the tea leaves for 2022. Here's a chart that kind of depicts the unemployment rate in its purest form, what we call kind of the U3 unemployment number, and that's plotted against what is really known as the natural rate of unemployment. And this is something the Fed talks about. It is, based on an analysis and synthesis of several different parts of the labor market. But, as you can see here, we've had some oscillation around that natural rate of unemployment. And generally, when we go below this natural rate of unemployment, then unemployment does pick back up again. Now, if we go back to 2016, 2017, the last time that we kind of pierced this level, and as you can see, that red line has moved down. So the natural rate of unemployment, or the natural rate of natural unemployment rate, I should say, has moved down at least about a percentage point or 1.5 percentage points, dating back to 1980. But we've been below that line for several years now, and with the pandemic, that provided the odd dislocation. But we're actually back below that natural rate of unemployment. So it'll be interesting to see again what happens here. I mean, there is a demand for labor, especially lower and unskilled labor, that exceeds the available supply. And so there's a lot, essentially, translating that. I mean, there's more job openings than there are workers at certain levels to employ. And with that, I think the competition for labor will continue to increase. I think the unemployment rate will continue to slide lower, and wages are going to remain fairly sticky on the upside. So we see here in this chart, this is average hourly earnings. So this is kind of showing you what I've been talking about for the last few minutes in kind of graphic form. And you can see that, again, getting past the dislocations of the pandemic and kind of looking at things on a trend line basis. If you draw a straight line from, call it about 2014 here in the middle of the chart up to the present, you can see the line of best fit. It takes away those extremes related to the pandemic, and it shows us that average hourly earnings are moving higher. Of course we know that, but the question is how much higher are they going to move? And dating back at least to 2007, there really is no precedent in that time frame to the kind of our wage growth, if you will, that we're seeing right now. And I do think that this will probably break trend line and kind of hold and maybe even establish a new trend line for us in average hourly earnings, barring some type of economic calamity or something that would ostensibly send us into a recession. Now we'll go ahead and switch gears here, talk about the global backdrop. And this chart I thought was really interesting. It shows you that all of the stimulus out there, all we call monetary policy, which are central banks around the world making credit extremely easy. And of course, there are reasons to do that, the pandemic being the most poignant of those. But by and large, we've had low interest rates for a long time. And even though we are now seeing some central banks begin to raise interest rates, and we've obviously heard the Federal Reserve signal its intention to raise interest rates, and there's the expectation that we're going to get 3 rate increases next year. But by and large, you can see why some of the investment markets and the asset markets have witnessed so much appreciation lately. And this shows you in really three different charts here. We've got real rates, and we have seen the global stock to bond ratio move higher because of the low real rates that we've seen around the world. Now, the stock to bond indicator, on the middle part of this chart, I mean, it's becoming a bit elevated. I mean, people have favored stocks over bonds, riskier assets in a period of really, really easy credit. And then again, you can see the real policy rates down on the bottom, even though they have been, the nominal rates have been moving higher. Inflation's moved higher at a faster pace, and that's why we here have seen a rather stark downturn in real rates across the world, and that sets the stage for a lot of asset inflation. I do think that helps to provide some staying power, even if you pull some of that punch bowl away in the next year or so. There's still overall conditions, monetary conditions, are fairly conducive for asset price growth and asset price inflation. I wanted to I was looking for some information on kind of this divergence in developed versus emerging markets, because I think there is a case to be made that going forward, emerging markets present kind of a unique diversification opportunity. You can see here that going back over several years, that you have growth in emerging markets, which traditionally exceeds developed markets, right? I mean, there's smaller markets, so a small aggregate change represents in most areas a fairly strong percentage rate of change, and that's been pretty consistent here, even though the growth rates have dropped off a little bit in the last few years. But certainly relative to developed markets around the world, I think emerging markets present a kind of an interesting growth opportunity going forward and getting past some of the pandemic issues. Well, we've been talking for many months about this global recovery, and when it started, we were kind of viewing it as kind of a synchronized growth, and then we realized as we got into it a little bit more that because of the pandemic, it made some of the growth less coordinated, if you will, but nevertheless still growing. Now, there's some areas that are witnessing new lockdowns because of the Omicron variant, but by and large, you can see here, from this chart, which represents the percent of the countries in the world with composite purchasing manager indices over 50 on a 3-month moving average. And what does that mean? That just simply means that you have an expanding economy, and obviously 100%, you had very well synchronized growth right before the global financial crisis. And that changed rather dramatically because most of that was a US phenomenon. But then over time, you can see how that has rebuilt itself. And we're actually somewhat synchronized now. If you look at this and say that we're above 80% or more of the countries in the world are in growth mode right now. And so, again, notwithstanding what happens with Omicron, I think you look out over the next 18 months and you're going to see a global growth engine, not like it has been, not like we've been used to here in the US, but I do think it will be a positive growth engine which will help investments to some degree. I was also interested in what investors, and particularly institutional investors, are doing in terms of their allocation. And you can see in this chart, which has a lot of information on it, kind of going from left to right, you've got different categories and different style considerations, large company versus small company, and value versus growth, and domestic versus international. And you can see here that portfolios, by and large, are fairly diverse. I mean, the institutional investor is generally much more diversified than the average individual investor. But you look at folks, by and large, in the first three categories, as we're debating whether we're still kind of witnessing expansion from a recession, or if we're in the throes of a cyclical expansion, you see people are really invested in both value and growth, particularly in large company. Not so much in smaller companies, but there is an allocation there. And particularly, you look at international markets, that there's definitely allocation there that's meaningful, and including emerging markets, which we were just talking about. Now, if you look at core bond exposure, that's still relatively high, but I think we've seen more people, more investors move into short-term bonds and also into kind of multi-sector bonds, which means like mortgages and collateralized loans, bank loans, and things like that. And then, we do see a lot of diversification within the fixed income sector, which I think is absolutely appropriate at this time. But, the long and short of it is you do see a lot of diversification here, and that's something that we're aspiring to, in terms of trying to position our clients, and especially in this unique environment, which I think we're going to experience over the next year. So looking back, over this century to date, I guess, if you will, over the last really the 20 years or so, this chart from JP Morgan Asset Management gives us a flavor of what the drivers of earnings growth have been for the S&P 500, and you can see, over the time period 2000 to 2020, you can see the average total earnings growth has been about 6%. Now, obviously, some years have been greater than that, and some years have obviously not been great at all. This year has been one of those really good years where, the comparisons were fairly easy, and our growth rate this year is probably around 68%. Now, the other interesting thing that this chart does for us is it kind of shows us where that came from. And, if you look at this last year, a lot of it had to do with margin expansion, like operating margins and internal profitability ratios are increasing. Revenue has obviously been a component of this, but not nearly as much as the margin side has been. And of course, that came off a year in which we had rather significant compression in margins. People were struggling with the shutdown, and that was creating all sorts of financial havoc. But generally, you have a mix of both of those. It's just that we've had tremendous margin expansion, over this past year, which kind of then begs the question, especially with some of these higher input costs, that whether we're going to be able to enjoy the benefits of this margin growth going forward. And I would presuppose that that revenue is going to certainly be a component of growth. And I do think that revenue probably is more of a proponent of growth in 2022 than it has been this year. But then perhaps we see very little, if no growth from margin in 2022. Talking about volatility, so you've heard me talk about the VIX in the past, and that's in the orange. The MOVE index is basically a measure of volatility within the fixed income markets, and we've seen both of those exhibit bouts of elevation, especially as we kind of look at the rhetoric on interest rate increases over the last several months, and in particular, following the Fed's admission that maybe they kind of missed the mark on calling a lot of this inflation transitory. And so volatility in the fixed income markets has actually picked up at a greater pace than the volatility in the equity markets, although both remain higher than they have been. And I think this is kind of the stage that gets set for us as we head into the first half of next year, is that for portfolios that have a lot of longer maturity instruments in their fixed income portfolio, that you could actually have more risk from fixed income than you do perhaps in the equity side. And so it's really important as we sit on the eve of interest rate increases and interest rates generally moving higher to kind of minimize that bond volatility as much as we can. So here is a look at S&P 500 earnings. We were talking about that just a few slides ago, but this actually provides us a window into what the future may hold. And I think this is very emblematic of the consensus opinion. It's certainly emblematic of my opinion. When you get into 2022 and 2023, that we're going to see earnings growth rates that look a lot more like historical levels. Earnings we do, next year they're obviously with earnings expecting to increase at a slightly faster pace than revenue, 8.4 to 7.1. There still is the expectation that we're going to continue to get maybe a little bit of margin expansion still next year. I'm not sure I'd bet on it, but if we did essentially 7% growth in earnings next year, which matches the estimated revenue growth rate, that would be actually very, very much in line with historical averages. And then again, if you look at 2023 and you assume maybe that the growth rate in earnings and revenues is somewhere between that 5 and 9% range, again, it'd be very consistent with long-term historical averages. And I think we could all be pleased with that, getting back to the long-term average annual growth rate in the index of somewhere close to 9, depending on whether you're reinvesting dividends for, a little bit over 9 to 10 to 10.5%. Here's a quick chart that shows you the rotation back into defensives. Really over the last several weeks. And of course, we've seen more volatility the last 2 months in the market than we have, in the preceding, 6 months prior to that. But, what's really happened here is we feel like maybe, interest rates are going to move higher. At least that's what's being telegraphed out there. And at the same time, we've got this Omicron variant. And at the same time that we've got some different things going on around the world, both from a health standpoint, geopolitical standpoint, so on and so forth, that we have seen a rotation out of the cyclical trade into defensives. Now, if we are in fact in a longer term, slower growth, mid-single digit to maybe high digit growth rate like we saw in the past slide over the next several years, then I would expect this to turn around at some point. There's a fear trade that's been well established, and some of those defensive have lifted us out of some of this volatility, but I do think the rotation is still intact that gets us to a point where cyclicals are going to be fairly strong and representative of growth in this market. Now, I came across this and I thought that was really, really interesting. So this is another one of those charts that shows you, okay, why do we have asset prices moving higher, like the equity market? And there's a really strong relationship here in this chart. So basically, you've got the real yields, which we know are going down and are negative right now. You can see in this last data point, it's negative 1.14%. But that's plotted against this growth versus value and kind of a valuation indicator. So I didn't think that I had no idea that this relationship was that strong actually, but it just shows you when you have negative real yields or declining real yields that you tend to have growth outperform. And obviously we've seen that over the last several years, very, very distinctive trend there. Now, looking ahead, we do expect real yields to moderate and move higher because we're going to have interest rate increases, and so that negative real yield should begin to taper. And so this is another one of those things that tells me that maybe value has or cyclical stock exposure has a place in portfolios right now because of this very strong relationship that we see here. Well, as we continue our conversation about the equity markets, in particular here, the S&P 500, this is a plot by year going back to 2010 of where the targeted level of the index was going to be relative to where it actually ended up. And you can see here that the target heading into 2021 was about 4,000, and obviously we're meaningfully above that. And some years it works out, some years it doesn't. But by and large, you tend to have an end of year number that's always going to look something different from what you expected when you started. And you look over at 2022, the market expectation as it stands right now is about 5,200, which represents a low to middle double-digit year-over-year increase from where we are now in the index. Maybe perhaps a little bit on the lower end, like say 12% or so, from where we are now. So obviously this is just a target. You can see how the target has expanded as we've been in the longer term cyclical expansion prior to the pandemic. And again, you can see where in many respects, it has some predictive power on where you actually end up. But, suffice it to say that there is a reasonable expectation for growth in the markets next year. Here's something else I thought was pretty interesting. And we always talk about how the markets aren't like the economy, and they don't often move in lockstep, right? And so they are on a longer term basis, absolutely correlated, because you have to have a growing economy to eventually have growing stocks. But the interesting thing, and I've kind of looked for a chart that kind of told that story, and this one does. If you look at the middle of this chart, you have the S&P 500, and it is only 36% correlated to overall economic growth, and that's pretty impressive. Obviously 100% correlated would imply that they do move in lockstep, and you can see here clearly that 36 indicates that they do not. And so you do have periods where the market is not where the economy is not growing, but the stock market is. And some areas of the market tend to be a little bit more correlated to what happens. Energy, financials, and real estate, very cyclically exposed to what happens in the overall economy. And so when you talk about cyclical exposure, we're really talking about a lot of these things in the upper part of this chart. Obviously technology has led when we've been in a period of weaker growth, and you can see that the technology actually has a negative correlation when things are moving high. So you tend to see a rotation out of high-flying technology stocks and more into financials and industrial stocks when the economy is in a sustained period of growth. And that's why you see those correlations in industrials, financials, energy much, much higher than in technology. And so, as you look out into 2022 and if you're comfortable with the expectation that we're going to grow in this normalized environment after all of the shocks, positive and negative, related to the pandemic, but going forward, if you assume that there's growth, then you should assume that these areas that have higher correlation to that growth are going to outperform. And this is really the basis for this conversation about having some of this cyclical exposure, having some of these stocks that maybe are more value relative to growth. We've already talked about small caps a little bit, and this is a relative look from the Financial Times in small caps versus large caps. And this has really, again, been a problem for multiple years, seemed to be exacerbated after the pandemic. And so when you look at relative valuations, the small caps are actually really attractive right now, where portfolios have not had small caps in them for quite some time. It's actually been a good thing because if anything, they've been a bit of an anchor on returns. But if you look at in relative terms, small caps were really, really cheap in the throes of the market long-term market correction we had at the beginning of the century that was kind of initiated by the bursting of the tech bubble. And we're back at those levels now, and I think it's important to take stock of that and say, I think relative valuations, probably don't have too much farther to fall, and might present a unique opportunity going forward. We've got a couple of charts on the energy sector. This chart is on natural gas. We've actually had a fairly strong reversal of sorts in NYMEX natural gas prices. This is good for households as we head into the peak heating months, as we know that a lot of heating demand is now being satisfied via natural gas. And so when we think about the impact on the consumer, on the average household related to energy costs, I think we can take some comfort here that gas prices have mitigated somewhat. Now on the oil side, we've obviously seen a bit of moving around in the oil price, and we've, on net, we've seen a really strong recovery. But what's interesting is you look at the dotted red line in the top half of this chart, it hasn't kept pace with that blue line, which is the oil price. And even though we've had oil prices move in a percentage basis meaningfully here in a fairly short period of time, the delta remains really, really strong between what you would expect rig counts to look like. And so the takeaway from this is that you've got on the bottom part, you've got prices relative to rig counts that are completely out of range right now. We're in this highly unusual environment where, we have prices that are much, much higher than rig counts. And so what you usually see is a supply response in this case, and then you see those rig counts move higher, and then you see that those two lines begin to converge. And right now we're at this unusual point where a lot of the independent producers, are focusing much more on cash flow than they ever have before. Usually you see kind of almost a knee-jerk reaction from independent producers that are filling the gap in some of these major production zones like Eagle Ford Shale, Niobrara, some of those areas, certainly the Permian Basin where we've already seen a supply response. But they're being a little bit more guarded this time around. And so I do think we'll have higher prices for the time being, but I do think that supply response kicks in. And as I've said in this charts of the week and in our market minutes over the last month or so, I actually do think that energy prices could be a kind of a disinflationary impulse on the overall inflation basket in 2022. Well, as we've been talking about volatility in the fixed income markets, here's more of that. So the 5-year government bond yield has actually moved down by about 10 basis points here over the last week. And so we've got a lot of data on this page. So in the upper right-hand corner, you've got basically the difference between the 30-year Treasury bond and the 5-year Treasury bond. And as you've seen, the 5-year Treasury bond yield go down, you've actually seen the spread between the 30 and the 5-year actually move higher. Usually when you see that kind of steepening, what we call kind of a bear steepening, if you will, it's usually indicative of higher expected inflation. You typically see, the short-term rates move higher, but then you see longer-term rates move at a faster pace. And that's actually not happening right now, because in the lower right-hand corner, you actually are finding skeptics out there that don't believe the Fed. Now, this is a This green line is a trend line of essentially taking all of the plots or the expectations of the Federal Reserve Open Market Committee members and putting them on a chart where they think interest rates are going to be. And then on this page, you can see that it's plotted against the actual futures market, which is where the market thinks that rates are going to be. And you can see that the market is not as is enthusiastic about predicting higher rates as the Fed is. So usually the market is right, so maybe this will change. I'm not sure, but right now we're looking at Fed funds target rate, at the end of maybe 2023, somewhere around by this chart, maybe about 1.6 relative to really 2.1 is where the Fed is. And so again, time will tell, but I think there's a little bit of skepticism in the market in the fixed income rate world right now. Here's a chart on real yields. We've talked a lot today about real yields moving lower. Again, this is not a new phenomenon, but we've seen this happen over a long period of time. They just accelerated. If you look at the U.S. 10-year, I mean, we were straddling, but remaining positive in real yields for a long time until recently. So we've obviously gone negative, but we're not the only country in the world right now. Again, this has helped to fuel kind of this, this longer term increase in asset prices. And I do think that real yields will remain low, although as we talked about a few slides ago, I do think that real yields will turn around from current levels. They just may stay negative, but they'll ostensibly be higher than where they are now. And then we've got just a couple of slides of interest to kind of finish up on. So I found this in Bloomberg, and this is a plot of the cost of generating electricity to the cost of delivering it to the consumer. And you can see very clearly here where costs have moved higher for delivery of energy and delivery of that power generation capacity to customers. At the same time that generation costs have actually gone down. So you think about the advent of solar, wind, predominantly wind, maybe moving from coal to natural gas, costs of generation have gone down a little bit at the same time that the delivery has gone up. And finally, something that is of near and dear interest to my heart is the craft brewery industry. And anybody who spends a lot of time at your local brew pubs or tap rooms will certainly understand this chart. Just so we've seen over the last decade an explosion virtually in the number of brew pubs, basically independent breweries that have brew pubs, independent establishments. Again, this is a very small segment of the economy, but it's pretty interesting for those of us who like to drink independent beers. I thought this would be of interest to those of you who share that same affinity. Well, that will do it for Charts of the Week. I hope you've enjoyed it. This will actually be our last Charts of the Week for the year. And due to some travel, we will not have Charts of the Week next week or the first week of the new year. And we will recommence the Charts of the Week on the second week of the new year, at which time we can talk about our outlook and thoughts on 2022. Overall, we'll have some data and some opinions to share with you. And the same will be the case for our Market Minutes publication as well. We'll go on hiatus for a couple of weeks. But I hope you have a wonderful holiday and a wonderful new year. Be safe if you're traveling, and we'll talk to you again soon. Thank you. Bye-bye.